Bond yields are now at zero everywhere. And I think the US probably ends up with negative rates at the end of this too, much like the UK just went negative over the autumn. So we're negative to zero interest rates. So basically, there's no juice left in that trade. So the biggest trade in the world is gone. Okay, credit. I'm not much of a credit guy because you need a bit more knowledge of the underlying, credits themselves. But if you're trading credit as an asset class, as many macro guys do, well, the Fed and the ECB just stopped that game, as did the BOJ. They've basically said, we're not going to allow the credit markets to price risk because we can't. And the reason being is we have this old population and they've got all their money in pensions. If you wipe out the pensions, you wipe out the savings of the baby boom generation, which is the largest generation on earth. So that's not going to happen. So now you don't have a credit market, and you've seen triple B credits are now all-time low yields again in the middle of an insolvency event. Brilliant. So no mechanism to price. The equity market basically took all the strain. So the equity market, people said, well, let's look at tech stocks that kind of look like, perpetual bonds or zero coupon bonds because they generate cash, they've got no debt. So we can price those to infinity because where else do we put our money? I get it. Is that right or wrong? I don't know. The macro guys are all trying to figure it out, but they're very nervous of the equity market because nobody understands this new paradigm. Is it real or not? But then the big one is coming, and that's the death of the currency market. That's something that I've been talking about. If that goes, then macro is finished. Because currency, like bonds, is enormous, super liquid. Trades for 3 or 4 trillion a day. So it dwarfs anything else. Now, what we've heard from the IMF, the BIS, the Bank of Japan, the Bank of England, the ECB, the Fed, People's Bank of China, and everybody is this move to digital currencies. And I'm sure we'll get in a bit more about that in a bit. But what's been clear is the IMF are pushing for an agenda which is the new Bretton Woods. And Bretton Woods was an agreement amongst nations basically to peg all their currencies to gold. And then famously Nixon came off the gold standard eventually. But that was a post-World War II construct that allowed all nations to kind of not compete with each other on interest rates, to build a platform of which, once they built Bretton Woods, they built everything from the United Nations to the World Bank to the IMF and all of these institutions that we know. So if the IMF are saying this, what are they saying? So I've gone through their speeches and they're basically saying, okay, we're in an extraordinary situation right now. Countries need to print money to fiscally stimulate, as we talked about earlier. But it's kind of difficult to do it. And if you fiscally stimulate to the amount that you actually need to, let's say, do proper stimulus, not just giving a check, but creating jobs by creating industries and all of those things that need to happen, well, that's like 20 or 30 or 40% of GDP they need to do. How do you do that without devaluing your currency? And the answer from the IMF is do it all together. If you do it together, then what are you devaluing against? Well, hard assets, Bitcoin, gold, stuff like that. But you're not devaluing each other. You're not winning terms of trade. This is the idea that Facebook Libra had, which is create a basket of currencies where the dollar is one of the currencies. It's not the denominator. So if you think of everything else, it's like euro against dollars, yen against dollars. What they're talking about is having the dollar in the basket. If you do that, then the denominator is money supply. So it becomes a very stable thing because money supply, yes, at times it goes a lot, but it doesn't grow that much. So then what you're basically doing is dampening currency volatility down to zero.
And so in that world, let's say that we play this out and they actually successfully create, a basket of existing sovereign or nation state backed fiat currencies. And there's kind of this quote unquote one world currency, right? However you want to think about it. One, that kind of removes all competition between countries, right, in terms of interest rates and all of that. But two, how does that change what I'll call just the management of monetary policy at the individual country level? Is there still some level of sovereignty and each country can kind of do certain things within parameters? Or does it almost get consolidated in some sort of like global central bank type situation?
Don't forget, Bretton Woods was essentially a consolidation. But interest rates, countries still need to borrow and lend, and there is an interest rate market. So it's not what the ECB is doing, which is creating a single currency. What it is creating a currency basket of which currencies move around and change their weights within it. So it's more like the S&P than it is the euro. So it is different, but I think it opens interesting dynamics of, okay, let's say they do this. Let's say to be a member nation of this bank core, which is what Keynes talked about back before Bretton Woods. He said, why don't you do this? It's basically the same idea, roughly. So to be a member, let's say, okay, all members are allowed to print 50% of GDP this year, altogether. So everybody does their printing, everyone does their fiscal stimulus. After you do that, you're limited to 2% money supply growth. Or if not, you're out of the basket, so you get worse trade terms. Okay, well, that's interesting, because then you're actually turning it into something that has a limited money supply growth. It actually looks a bit more like Bitcoin. Obviously not in many ways, but in terms of supply. Now, will nations cheat? Will it all go wrong? Of course, they're central banks, of course. But, there's interesting mechanisms that they can create out of this. And I think there was a tweet that Sahil Bloom put out today about the Overton window. This is an Overton window. Basically, anything is up for grabs, much like it was after the 1930s when all of these institutions were built, and after World War II too. Anything can happen right now. And this is fascinating. This whole central bank digital currency thing, that's going to lead us into a whole new world. But the death of macro seems like it could be a reality. Now, obviously, that's slightly flippant because macro moves around into different areas. Now, in a world like that, what does it mean for emerging markets? It's probably exceptional. Because let's say you're South Africa, you get killed every time the dollar goes up and you can't export your goods and all of that sort of stuff. But if you have a stable currency to trade in, well, you're going to do much better. So it's probably incredibly positive for emerging markets. Okay, that's interesting. What does it mean for commodity markets? Well, maybe they become less cyclical. How do countries compete with each other? I don't know. It's probably technology. It's, how do you attract capital in that world when it's not interest rates necessarily? It becomes really interesting as a thing. And, and then how does obviously Bitcoin and gold and stuff like that fit into that? Really interesting. So macro could shift it. Maybe it doesn't. But there's a once in a lifetime, not even a lifetime, a once in a century opportunity to change the construct of the system. Now, whether it's any better or not, I think it'll be better, but it won't solve the problems. Fiat money is a bigger problem itself.
For sure. And I think one of the most interesting things is as this kind of death of macro trend accelerates and becomes kind of more real, what we're starting to see is many of the quote unquote legends of Wall Street, who really are just macro traders who have done very well for themselves. One by one, they're raising their hand and kind of revealing their interest, intrigue, and positions in crypto in general, right? Usually it's Bitcoin they start with, but kind of you see everyone starting to not just do it, but be public about that position, to go on television and talk about that bullishness that they have behind the trade. Let's start with Bitcoin. I think last time we talked, you were kind of single-digit percentage exposure to Bitcoin, and then you had kind of what I'll call quote-unquote traditional portfolio, but traditional for you versus others. Now you are 98% of your liquid net worth is invested in crypto. I think it's 80% Bitcoin, 20% Ethereum. Let's just start with like what changed or what were the things that went into you going from single digit percentages to more than majority and kind of almost all of your liquid net worth being so bullish on Bitcoin and Ethereum.
And again, look, I'm a macro guy, so I don't expect anybody to follow me. You do the same with your allocation. You're looking at it from a macro perspective. Other people can't take the risks. But for me, I looked at the situation. All outcomes for me were, now it rarely happens. Let's say I'm right. Deflation is persistent. The economy is worse than expected. We don't get rid of this whole economic mess until, let's say, Q3 next year. Okay, so the answer to deflation and slow economy is printing of money and more fiscal stimulus. Okay, let's then push that aside and say, no, Raoul's a total idiot. He's completely wrong. The markets are right. Inflation is everything. In an inflationary market, well, Bitcoin and gold do well. So here we've got a smile where the least likely outcome, which is everything just returns back to kind of 1.5%, 2% GDP growth, and we all forget it's just happened. That's not going to happen. It's simply not going to happen. Maybe it does, but that's the risk that we all run in the Bitcoin position. So basically, inflation, deflation of any sort, if we look at all the past episodes, whether it was 2008, 2012 in Europe, when Europe almost went under, and then periodically afterwards, the central bank kept stimulating, didn't stop. They're not going to stop here. So that to me is a good setup. Okay, so I've now got a good case. So then the case is okay. At that point, I said, right, gold, Bitcoin, those are my main bets. I own some bonds because I'm a deflationist, and I had some dollars and some other trading positions. Okay, fine. So then what changed is the charts. You know, we'd all been looking at it, that the chart of Bitcoin was this beautiful, beautiful wedge pattern, triangle pattern, and it broke. So of course, I'm a macro guy. I can see an opportunity. I can see a great chart. When I see one, I start saying, right, look, we've got to add to this. And, you know, I added obviously into the big sell-off as well, because I saw this pattern emerging. So then it breaks. I start adding. Okay, so now I'm over 50%.